You are listening to Finance Roundtable, a podcast focused on demystifying money. The hosts, Professor Jacob Gold, Michael Cochell, and Kelvin Gold, will educate and entertain you in all areas related to money. Sit back, relax, and enjoy the show.
Hello, everyone. Thank you for joining us. This is the Finance Roundtable podcast. I'm Professor Jacob Gold.
And I'm Michael Cochell.
And I'm Kelvin Gold.
And over the last year, we've had a lot of fantastic guests, from New York Times bestselling authors to active NFL players to finance professors. But today's guest is perhaps what I would consider the GOAT, the greatest of all time. We are so excited to have David Giroux here on the Finance Roundtable podcast, and really interested to hear his thoughts on the markets, things going forward, volatility in the short term, and just getting to know a little bit more of behind the scenes of the T. Rowe Price Capital Appreciation Fund. I had the great honor of meeting David probably some 20 years ago when we attended a Morningstar investment conference. We both were newbies at the time, or at least new-ish, and we hit it off. And since then, we've been in loose contact. And fortunately, he was gracious enough back in 2008 during the Great Recession, when investors were concerned about the market and long-term prospects for growth. David came out to Scottsdale. We hosted a client event, and he spoke to our clients for a couple of hours about the markets, how to keep their nerves nice and calm, and to not focus on the present, but focus long-term. I still have clients talk about that event, and we are still so very grateful for him to have hosted that and speak at that event. But without further ado, David, welcome to the podcast. Thank you so very much for being willing to be interviewed.
Oh, no, it's my pleasure again. Thank you for the kind words, and again, looking forward to the conversation today.
Thank you. I appreciate that. Well, you know, a little backstory or a little bit of information about David. David has been a Morningstar Mutual Fund Manager of the Year twice in his career. He's also a part of Barron's Roundtable. I have two issues here. Right here is a picture of David, as well as on this cover of Barron's. There's David right there. And I can't wait to hear from David on this Barron's Roundtable panel, who's sitting at the table with him, as well as kind of the process. So David, would you mind maybe starting off? And I'm so intrigued by this roundtable. I get up every Saturday morning, eager to read Barron's. And at the beginning of the year, they always have the roundtable panel for, 2-3 weeks. And I see your picture, and it just brought joy to me. You were already booked for the podcast. And so I just was like jumping up and down, so excited to hear your commentary. So tell us a little bit about the roundtable, and if it's something that you enjoy, how you got started with it, and what the process looks like.
Sure, I've been doing the roundtable for now 2 years, and it's basically it's a long day. We all arrive at 8 a.m. We usually have dinner starting about 8 p.m. So it's about a 12-hour day. The first 2 to 3 hours are mostly on macro issues, interest rates, foreign exchange, big views of the market up, market down, that kind of stuff. The second, let's call it last 5, 6, 7 hours, are more each of us with our stock picks or our mutual fund picks, if you will. I sit by Henry Ellenbogen, who used to be a portfolio manager here at T. Rowe Price, now has his own firm. He's on my right, Scott Black, who's been on that panel for a very long period of time. He's on my left, and it's fun. It is a lot of work because you have a lot of very, very talented investors in that room, as well as reporters. And so when you pitch a stock, you need to make sure you know all the details and have all those at your fingertips so that you can respond in real time. So it's a long day, but it's a good day. I enjoy working with those people on the panel. Enjoy working with the people at Barron's, and it's really an honor to be on the panel.
Oh, absolutely it is. And I'm sure you're exactly right. You've got to be loaded for bear going into that meeting because you have to defend your thesis. And some of the all-star panelists, they're not afraid to say, well, I disagree with that. And these are the reasons why. And so it seems like it's a healthy, friendly debate at times.
Oh yes, yeah, it's always friendly, but I feel like I'm the young guy on the panel, so I get they ask me a little more questions than Mario gets sometimes, I think. So it's
Yeah, for sure. Oh, that's great. Well, I did notice that in your commentary, um, a lot of panelists were saying that for 2024, they're kind of assuming a range of -5 to +5. And it sounded like your 5-year prospect was maybe around 6.5% a year. Does that kind of still hold up based on recent upside swings in the market?
Oh yeah, I think that's right. Again, I think predicting the next 1 year is always a very, very difficult. It's something that a lot of people ask us for, but I think the range of outcomes in any 1 year is quite wide. In all honesty, I always tell people our North Star is kind of what we really focus on is on an investment perspective. It's really not what the market's going to return in the next 5 years, but how, because we don't invest in the market, we own 50, 60 really amazing companies that we think can compound, wealth at 400 to 500 basis points a year faster than the market. And so that's really what we're focused on, right? So yes, I think because we've had very elevated returns here recently, because the market multiples expanded pretty dramatically, and because honestly, probably rates will probably be higher than they were pre-pandemic.
I love how you say we're not investing in the markets, we're investing in companies, because I think a lot of times there is that disconnect. And in reality, you are buying a company and assuming there's internal growth of the company. And that is quite independent of what the broad marketplace actually does in a very short period of time. So I thank you for saying that. I think sometimes people lose sight of that.
Yeah, I think that's right. I mean, and a lot of the companies we own, it's not that they won't be impacted what happens in the overall market, but the idea is their earnings are a little bit less volatile than the economy is. We tend to favor more GARPy stocks, things that are a little bit more healthcare, a little more utilities, a little more waste companies that whether the economy is good or the economy is bad, we still need electricity, we still need to throw away our trash, we still need to go to the doctor, right? Those kind of things that are a little bit less cyclical, which makes modeling out those companies on a 5-year basis, a lot easier.
Absolutely. I think that's really great with all the uncertainty from the conflict in Ukraine, the Middle East, the presidential election, to really focus on those companies that have a consistent glide path based on the needs of everyday individuals. I think there's a lot of value there, and your returns have shown that. So that's really fantastic.
Thank you.
Absolutely. To kind of shift gears a little bit, I know that a buzz topic that a lot of people like to discuss is AI. And based on, once again, some of my readings of your commentary is you feel like we're kind of in the early days of AI, and you have some forecasts of how AI may benefit productivity. Could you share a little bit of that with us?
Sure. I really do believe we see a lot of kind of survey work for Fortune 500 companies. And they ask in these surveys, companies, where are you in rolling out AI to benefit your firm? And I think 90% of the companies are saying we are early stage, we're beta testing. Even probably a company like Microsoft today, which is probably the furthest ahead of anybody on the AI journey on software. Even Microsoft saying it's basically going to add 1 to 2 points to revenue growth this year from AI. So, and they're probably farther ahead than a lot of their competitors. So, very early days with regard to AI, but I think the opportunity is pretty compelling on a longer term basis. And you, Jacob, you mentioned productivity is an important thing. And so I tell people we have one case we can all point to, right? We can all point to, there's a thing called GitHub Copilot. It costs about $19 a month. And today, GitHub Copilot, what it is used for software programmers or developers or software engineers to essentially make them more productive in how they write code. And today, depending on who you talk to, it's somewhere between 25 and 50% more productive. And the average programmer costs today about $100,000 a year, a little more than $100,000 a year. So if you had a firm with 100 programmers, $10 million a year of expense. You have the software that costs $19 a month that could literally probably replace 25% of their programmers, save $2.5 million at a cost of about $17,000 a year for the rest of the other 75 people who don't lose their job. So maybe it's one data point, but the return on investment from doing that is so amazing. Mm-hmm. Again, I'm not saying everything we're going to see is that kind of IR, but when you think about things like computer programming, you think about customer service, you think about accounting, you think about personalized marketing, journalism. There's so many things that we think anything that touches anything that is involved with gathering information and then giving that information to someone else. A lot of that is going to be replaced, if you will. And that's, I think that will structurally, unfortunately, will probably structurally increase the unemployment rate in this country, especially among white collar workers. Again, not saying we're going to go to 10%, but for the last decade, we've been below 5%. And I think if you think next 5 or 6 years, I think that unemployment rate will go up steadily because of AI. And we're just going to have to deal with the consequences of that over time. But I think that is one of the reasons why, one of the reasons why we're also a little bit more positive on fixed income. I'm sure we'll talk about that a little bit later. But I think AI will help drive inflation closer to 2% over time, if not lower over time. It probably makes fixed income look more attractive than it is otherwise. So I think that's interesting to us.
Amazing, fascinating, David. That insight, it is a topic that is so popular, but the depth that you just went to is something that I haven't heard much of, and that's talking about all the possible outcomes. Because people tend to look at historical return and they just put all their bets on one company based on recency bias. And I think it's really important that the landscape of competition is constantly changing, and you've got to look at all the possibilities.
Yes, I appreciate the comment. It is. There's a tremendous amount of recency bias in the markets. What's worked in the last year will work in the future. And that's just not the way it always plays out, unfortunately.
It's true. Well, I've been hogging the mic this whole time as the host. I want to turn it over to Michael and Kelvin. I know that they have some questions as well. Mike, do you want to go first?
Yeah, first, thanks for the comments on the AI. And you know what? It reminded me of how remarkable this opportunity is, and the idea how infrastructure is still in its infancy on how companies will lean on AI, as well as where we're headed. And the other thing that sparked attention was the reminder of companies. Originally, you had mentioned that the idea of not investing in markets, but companies. And some of what you alluded to is really staying focused to that, even though AI is kind of, I don't know, this it's out in the air and how it may function. We don't know, but there still needs to be attention to the companies that makes this possible. So thanks for that insight. I haven't heard that perspective either, but it reminded me of the attention towards the companies that make all this happen, not just the markets and what we see in thin air about what AI can be. So thanks for that. Mm-hmm. Okay. And I actually I do have a quick question. A couple of days ago, I thought about it. I'm like, this is perfect. Since we're going to have this podcast, it's the perfect time to ask this. And as Jacob mentioned earlier, we really appreciate your time here. So here's my question. The media tends to draw so much focus on topics and areas that tend to be skewed many times in, whether it's fear or greed or all the commotion during that year. For the average investor, the individual who's saving for retirement or future needs, what might be your feelings if there is a topic or area to stay focused on and just read about, pay attention to in the next maybe 12 to 18 months? Is there something that stands out to you for the average investor to pay attention to rather than what the media might do on a short-term basis?
It's a really good question, and I hope I get to the heart of your question here. What I always tell people, and it's one of the hardest things to do in the marketplace, right, is that when things feel good, your forward returns are actually below normal, and your risk of loss is actually elevated, right? Mm-hmm. And when things feel bad, when markets are down, when VIX is high, when you have celebrity CEOs and celebrity economists calling for recessions, it's actually a really good time to invest, right? I think investors, you think about your clients, people wanting to retire on a long race. My mother, what you really need, you need to invest kind of counter cyclically, right? You need to, when there's negative sentiment in the air, good time of recessions, and people are scared, and valuations are attractive for really good companies, that's the time to actually add to risk assets, not pull out risk assets off the table, right? And in a period of time where things feel good, like things feel good today. But I know from history that when things feel good, the forward 12-month return is a little bit below average, not horrible, but it's below average, and your risk of loss is elevated. Not dramatic, but it's higher risk of loss. So I always tell people, if they can kind of institutionalize that in their brain, and that is the way the world works, that's what history would tell you, is the next time the market falls 10%, you shouldn't think about equities being more risky. You should actually think this is a great opportunity to be buying more. Market down 20%, you be buying more, right? As opposed to, the market's down 20%, I got to de-risk. Well, market's down 20%, you're right, you're too late in the process. Market's up 20% doesn't mean the market is going to continue to go up 20%. It just means the forward returns going forward are actually less good, right? So for individual investors, adding to risk assets when things feel bad is a great time. Reducing risk assets when things feel good. It's kind of counterintuitive, but it's actually a way to create a lot of value over time. And so that, we've done it with CAF, whether, Jacob mentioned what we did, we added to risk assets in 08 and 09. We added risk assets, obviously, during the COVID downturn, and we added to risk assets pretty aggressively in September and fall of 2020, not because we knew that the market was going to go straight up from those events, but basically because looked at over a 3 to 4 year period, 3 to 5 year period of time, and we knew that the risk returns from here were compelling, right? The risk returns from here in the equity market today are not compelling. They were compelling in some of those periods where you've had some weakness. So I hope that gets to the heart of your question, Michael. I think, but if I just leave people to that one concept.
Yes, it does. And what sticks to me is when you mention institutional mindset, and it kind of takes away the emotional aspect of making decisions. And if investors can remind themselves that think of it that way, then I think it separates that emotional aspect of decision. So that was perfect. So thanks, I appreciate it.
Oh, good.
Yeah, David, I've got a question for you.
Okay.
I just want to start out by saying you might be the smartest person I've ever met.
That's definitely not true. That's definitely not true.
That's definitely true. I've been listening to your past two responses, and I am just amazed by the information you're throwing out. And Michael and my dad have talked very, very highly of you, and I understand why they love you so much. But, a little bit different from market talk. I just want to know, what did you do to get into the marketing management position? What did that look like getting in there? For me, it's a little bit different to understand what that's like getting there. How was it for you?
Okay, it's a good question. So, when I was probably actually almost, I know Kelvin, you're a junior this year.
Yeah.
When I was about a junior, I decided that I wanted to do this. And so the way I originally tried to teach myself about investing is I just basically read every book I possibly could about investing. I think over a course of a year or two, I probably read 40 or 50 books on investing. Things about The Intelligent Investor, Security Analysis 1 and 2, Analysis of Financial Statements by Ben Graham, and everything Warren Buffett has ever written as well, and a variety of other books on investing. Some that were good, some that were less good. But that really helped. It didn't teach me how to model. It didn't teach me how to, to do the day-to-day interviewing of a management team. But what it did do is give me that kind of mindset of the idea of margin of safety, trying to find situations where the risk reward is really on your side. So when I walked into T. Rowe Price, I was not great at Excel, wasn't great at modeling, wasn't great at interviewing management teams, but I did have that mindset, the right mindset. And I think that having that mindset, having read those books that I read, it really was it helped get me in the door to T. Rowe back in 1998 when I joined the organization. And then over, covering industrials for 6 years, what I really learned about a lot during that time is the importance of capital allocation and how can we deploy capital. And when I covered industrials for 6 years as an analyst, the organic growth rate for all my industrials, I covered about 40 companies, and the organic growth was very, very similar for those companies. But Danaher, Roper, Ametek were 5 baggers or 4 baggers in that period of time, and GE fell by 50%. So even though that same organic growth rate, because some companies like Danaher, Roper, Ametek made really intelligent use of their capital deployment. They bought companies, they improved companies, they improved the multiple that they were trading for, they improved their free cash flow conversion. And GE, on the other hand, did really expensive acquisitions that typically failed. They would divest them, and they were a bad stock result of that really bad capital allocation. So that was a really good learning experience for me, and just in talking about how important good capital allocation is. Because if you look at the Ropers of the world, the Danners of the world, the Ampex of the world, the AutoZones of the world, these were companies for 20 years that basically grew revenue organically 3, 4, 5% a year, and yet they were in some cases 10 to 15 baggers because of how intelligent they were about capital allocation. So that was an important learning experience for me, being that industrial analyst, and then being applied that not to just industrials as a portfolio manager, but to all other sectors. Like we found companies like Pfizer, Thermo Fisher, Rivety today, Linde, that had those same very, very good capital allocation instincts. And I think the last thing I would say, from my learning or my education was making sure that we understood the value of quantitative research as a complement, not a substitute, but a complement for good fundamental research. So, I spent a lot of time with our quantitative team led by Farah Shugi here at the T. Rowe Price Investment Management at the firm I'm at. And, that helps us understand the kind of characteristics we're looking for in companies, right? Companies that have Jacob and I talked earlier, but companies that have a little bit less volatility in their earnings stream, low EPS volatility companies, they tend to outperform with lower risk. GARP stocks, we know they tend to outperform with lower risk. GARP stocks outperform value and growth over time with lower risk. High yield bonds, the double B part of the market, leveraged loans, very high risk adjusted returns, if you will. So, it's working with quant helps us identify those areas in the market where there's inefficiency, where there's really good risk adjusted returns. So the combination of all of those things, good fundamental analysis, understanding capital allocation, looking for margin of safety, and understanding how quant can be complementary to good fundamental analysis is all really, really helpful in my journey as an investor. And I think the last thing I would just say is, I think we aim. We aim to get better every year. Every year I make mistakes. Every year I make a lot of mistakes I shouldn't make. But the key is trying to reduce those mistakes every year, getting better, learn from your mistakes, and be better every year as an investor, right? So you're not going to be day one as an investor, an A+ investor, but every year learn from your mistakes, get better, have a differentiated process. And I think that's I guess that's probably, I hope that maybe that's a little more than you were asking for.
No, that's perfect. That's perfect. Okay. Absorbing everything, all the information you've been given, just absorbing it and then, regurgitating it right back. It's perfect. Thank you very much. Thank you.
Good.
Guys, any last questions?
No, I think I'm good.
Yeah, no, thank you again, David, addressing all those questions. It's nice because I can learn some things from what Kelvin asked, some of what Jacob asked, and then some of the insight. It's kind of nice doing the podcast. So we have 3 different perspectives and questions from time to time. So thank you.
My pleasure.
Yeah, and as always, David, I mean, you leave us speechless. It's amazing. I think that the 3 of us, as well as our listeners, are just going to be like digesting all that you have said today. And there's a lot of wisdom in what you said. And it's all about looking at things long term, recognizing that there's risk in the short term, and diversifying and putting a lot of eggs in a lot of different baskets, but looking at the underlying company and their forecast. And so thank you so much. I think in this environment, having that type of wisdom is paramount. And Kelly knows this as well as Mike, that I'm a huge fan of Warren Buffett, as I know you are as well. And his wisdom is something that can really allow us to not only maximize our long-term potential, but I think to what you alluded to is allows us to be better individuals by learning from our mistakes and always just moving forward in a positive direction. So from the bottom of our heart, thank you so very much for joining us today. And we wish you all the success in the world. And we hope that you continue to manage T. Rowe Price Capital Appreciation for many, many more years to come, because we all benefit from your talent and your expertise.
Oh, thank you for the very kind words. I really enjoyed the conversation as always. So always happy to do this. And again, really enjoyed it.
Thank you, my friend. Okay, well, that is all that we have today for the Finance Roundtable podcast. Thank you for listening, and stay tuned for next month's episode. Thank you.
Thank you for listening to Finance Roundtable. Make sure to check out our episodes at www.financeroundtablepodcast.com. We also encourage you to explore www.jacobgold.com to find articles, research, videos, and more from Jacob Gold and Associates, Inc. If you have a question for the show, please email Jacob at jacobgold.com.
Jacob Gold and Michael Cochell are financial advisors offering securities and advisory services through Cetera Advisor Networks, LLC, doing insurance business in California as CFGAN Insurance Agency, LLC, member FINRA, SIPC, a broker-dealer and registered investment advisor. Cetera is under separate ownership from any other named entity. Jacob's California insurance license 0E55425. Michael's California insurance license 0K90130. The views depicted in this material are for information purpose only and are not necessarily those of Cetera Advisor Network. They should not be considered specific advice or recommendations for any individual. Neither Cetera Advisor Networks nor any of its representative may give legal or tax advice. Kelvin Gold is a marketing associate. Registered address is 14850 North Scottsdale Road, Suite 255, Scottsdale, Arizona 85254. David Giroux, Henry Evanbogen, Scott Black, and Farha Shugi are not affiliated or registered with Cetera Advisors Network, LLC. Any information provided by David Giroux, Henry Evanbogen, Scott Black, or Farhad Shugi in no way is related to Cetera Advisors Network, LLC, or its registered representatives. Due to volatility within the markets mentioned, opinions are subject to change without notice. Information is based on sources believed to be reliable. However, their accuracy or completeness cannot be guaranteed. Past performance does not guarantee future results.